All right, good morning, everyone. Tim Davis coming to you guys with a little quick video, and I'm going to call this one my pre-Fed press conference market review, just to show you guys what we currently look like as far as we're looking at the as far as related to the overall picture. I always look at the bigger aspect and look at the broader picture, especially within this bear market, to see where we stand as of now. And just before this Fed press conference today, I want to point out a couple of things. First of all, I'm going to draw you guys' attention to the new 52-week highs and lows as of the close of business on yesterday. And I always like to pay close attention to this because this pretty much can give you what the overall market sentiment is, especially leading into this Fed conference. This tool can be found on the Wall Street Journal page. And the easy way to get to this, I have this link posted in my Twitter, right at the top of my Twitter. Easy way to get to this actual link. Now, you have two choices. And I like to look at both of them, the New York Stock Exchange and then the NASDAQ. We're going to take a look at both. And first column we're going to be looking at is the New York Stock Exchange. And this first section up here tells you the amount of new 52-week highs. So as of the close of business yesterday, we had a total of 41 new 52-week highs. Now, the higher the number between the highs and the lows, whichever one is the highest, normally tells you what the overall market sentiment is leaning towards during that time frame. And the bigger the difference between the two, it shows you the extreme level that the markets are leaning towards one way or the other, towards the highs or the lows. Again, if you have many more highs than lows, then it's more or less signaling the bulls are in charge of the market and wants to continue to push price higher and drag the market out of this bear market. But so again, it's showing 41 52-week highs, and let's scroll down till we get to the new 52-week lows. And there you go, the new 52-week lows, 152, folks. So 41 new highs versus 152 versus 152 new 52-week lows. That leads me to believe that the overall sentiment is still negative. Still a huge negative sentiment. Now let's take a look, and that's a pretty big margin, 152 to 41. It's a pretty big margin. So the overall sentiment within the New York Stock Exchange is still showing a negative sentiment or bearish sentiment. Now let's switch over to the NASDAQ. And here with the NASDAQ, we see a total of 63 new 52-week highs as of yesterday. And let's scroll down. Take a look at the new 52-week lows. And look at that one. That's a whopping 447. 447 versus 63. You tell me, what's the overall sentiment of the market? Is still extremely negative. All right, now that we got that out the way, let's look at some charts. All right, let's start by looking at the S&P 500. I'm pulling out a couple of things here. Now, I'm going to look at just the longer term charts. We'll look at the weekly charts because I want to cut out all the noise, because we pretty much we've been range bound, folks. We've been range bound for quite a bit. And I want to highlight this so folks will see. Let's see if this is the one I want to look at. Yep. I want to point this out so folks can see where price action is. And pretty much we have been stuck in a range, folks. We've been stuck in this range for quite a bit now. I'm sorry, I'm looking at the wrong chart, folks. This is XLF. Let me switch this back. Ooh. This is where I want to be. Okay. All right, here's a look at the S&P 500. Again, we've been pretty much stuck in quite of a wide range pretty much. So between, you see the shaded area here. That's basically the bottom of the shaded area is right around 3,800. The top of the shaded area is around 4,200. And as you can see, we dipped below the range just a little bit back in September of last year, October, and then that's when we took off back towards the top of the range. But in general, we've been almost perfectly stuck in this range for over a year, between 3,800 to 4,200. And it looks like the bears have not really got the huge upper hand, and the bulls not really got the huge upper hand. Needless to say, this range has been strong and been pretty much stuck within this range in a convincing fashion for about a year. And now what price action is, we've been hovering around the top of this range. We've been hovering around the top of this range for a couple months now. Going into another Fed speak, where the Fed are expected to raise rates by another 25%, by another quarter basis point. And we had to see what their commentary is, what the press conference is, as to how these markets will react. But we're at the top of the range, so which leads me to believe that if we don't break out well above this range, then we'll probably be headed back down towards the bottom of the range. Okay, so that's where we are now. And the main concern is if we the markets don't get what they want to hear from the Fed, and we challenge the bottom of this range, I think eventually one of these ways is going to give. Either we're going to break out in a big way to the top of this range, or we're going to break out in a big way and break the bottom of this range. I think this one of these ways is going to have to give eventually. So again, watch out for these ranges, 3,800 to 4,200, over the next couple of months or so. And it looks like we're heading for another test of, we already tested the top of the range. Now, are we about to test the bottom of the range again? We have to wait and see what it looks like. That is a possibility. So that is the SPX, S&P 500. Again, you saw what the overall market sentiment is by looking at the tool that tracks the new 52-week highs, new 52-week lows. Is definitely still leaning negative. Now, before I switch to the Dow Jones, I want to point out one more chart that I like to look at, the SPXA 200R, which is another sentiment gauge that I check to see overall sentiment of the market. Now, this is a tool that I've been following for a number of years. And this tool pretty much tells you the percentage of S&P 500 companies that are trading above the 200-day moving average. So it gives you, the amount of stocks that are participating in the rally and where we stand. And it's also is another sentiment gauge. So I highlighted this shaded area because I wanted to point something out. The highest you can get on this level is about 97%. And when you're that high, that's normally signaling that the market is strong and it has a more bullish narrative tone to it. But when you're trading below the 50% area, so if you see, we pretty much traded down here for quite a bit at one point from April of 2021. Hit the high. Then since then we pretty much done a downtrend, and then we kind of like ricochet right around July of 2022. Showed a double bottom in October 2022, and then off to the races. But look at where we stalled out at. Could not make it back up to that 97. Pretty much stalled out right around 70%. And it looks like we started a range-bound trading level. But let me show you, if you look deeper into what's happening here. Range-bound trading level. Bear stopped him in his track. Could not go above that 70 level. And looks like we have what appears to be a possible head and shoulders pattern. Okay, also with negative sentiment showing in the full stochastics, which is starting to oscillate, starting to trend lower. Wins percentage starting to trend lower. CCI is in a downtrend. So this leads me to believe that we are probably about to break lower in this overall market sentiment tool, which also will spill over into the major averages. So it looks like we are sitting right at a level of resistance right at that 20-period moving average. And it looks like the candlesticks are showing us that we possibly are trying to head lower. So that's another negative sign as it relates to this overall market sentiment as we head into another Fed conference day. Right now, let's take a look at the Dow Jones. There's the Dow Jones weekly chart. Again, there's that range bound motion that we've pretty much been stuck in for quite a bit. This is weekly charts. We've been stuck in this range for a very long time. Since this started this downtrend, popped back up out of this downtrend, well, not out of the downtrend, they're still in the downtrend, but then had a little rally from October up until about the beginning of 2023, and then we've been pretty much stuck in this range. So we've been stuck in this range since since the beginning of this year or the end of last year. And markets are just looking for direction. Now look at the full stochastics. It's already showing that it possibly wants to turn and go lower. Rents percentage also hinging lower. CCI is still in no man's land. Looks like it may be heading lower too as well. That's what our Dow Jones looks like. Let's take a look at the NASDAQ weekly chart. Here's the NASDAQ weekly chart, same scenario. Back stuck in this range. And again, looks like oscillators are in overbought territory and starting to fizzle out. Rents percentage starting to fizzle out in overbought territory, like it's starting to hinge lower. CCI just hovering right around that overbought territory. So there's a decision that's going to happen soon, folks, and it's my guess that we're going to head back to the bottom of these ranges. Now let's take a look at the Russell real quick. Russell 2000. And I think out of all the Russell looks the weakest of all. It has been struggling, and it's actually towards the bottom of this range, folks, and looking like it wants to dive and go lower. Now, what's important to me about this Russell is the Russell is known the precursor as to what we can really start to see within the overall market and overall indexes. Russell is threatening to break up below this bottom of this range. And this range, the bottom of this range, folks, and I highlighted before, not only is it been range bound, we stuck at the bottom of this range, but the bottom of this range represents the top of the range in 2020. So in other words, this was the high in 2020 around this level, and then we hit that level, and we broke below that level. We are threatening to break up below the highs of 2020, folks, on the Russell. If that happens, then the bears are really going to start to sink their teeth into this market again and start to flow lower in a big way. So that's something to pay close attention to. Pay close attention to this Russell. We break below the 1640 level, we're going to really start to see some major issues. All right. That's all our major indices. We're going to take a look at crude oil, because crude oil also is giving us a signal. It's giving us a signal, folks, that if crude breaks down here, I'm telling you, the market's going to follow. And crude is threatening. It is threatening in a major way to break below. It's been in a range, and now it's back below its 20-period moving average, which is this blue line here. And now it's threatening to break below that $70 level. If it breaks below that $70 level and then breaks this little pivot point down here, which is at 64, we're going to start to see the markets end up following as well, folks. So that's just what the markets are showing us. Now let's take a look at the VIX, because the VIX is also something to pay close attention to, because everybody been watching the VIX and think that the VIX is it's really ready to break down in a big way, but no, it's just skating on the bottom of a range, folks. VIX dropped all the way down here it got all the way down below 16, but it keeps finding a way to bounce back. And if you look very closely at this weekly chart of this VIX, starting to form another green candle again. right before the Fed speak. In order for us to see a really strong bull tone to this overall market, and we're in a new bull market, is we have to see a major breakdown in the VIX, and not only a major breakdown in the VIX, but we need to see the markets going in the opposite direction, going up in a major way. That has not happened. You know, when the VIX has been breaking down, the markets have really not accelerated and broke out of their range-bound trading that it's been in for the past year or so. We need to see that happen if we believe that we're in a new bull market. That has not happened, and the VIX is continuing to threaten a big move higher. Now, looking closely at what the technical tools are showing us, look at the oscillators and the full stochastics in oversold territory, and it's showing a possible pivot higher, starting to try to show a pivot higher. That's a bullish tone for the VIX. Look at Williams percentage, same thing, trying to start to show a pivot higher out of oversold territory, and CCI as well showing a pivot higher out of oversold territory with a weekly green candle starting to form. So if this candle stays green by the end of this week, we still got like 2 days left. And if we find a way, weekly chart finds a way to pop back above this 20-period moving average on the weekly. I'm looking at daily right now, because daily we already did it at one point. We pulled back below it. But if we pop above this 20-period moving average and close above it on a weekly chart, then we probably saying that we say sell in May and go away is probably going to hold true to its word. So this is going to be a decision week for the overall markets. This VIX starts to break out on its 20-period above the 20-period moving average on its weekly chart, then we're probably going to start to see the markets really start to suffer in a major way. All right. Now, one more thing I want to point out before I head out. Another thing that's been giving us some pre-indication that the markets are flirting with the major breakdown is look at some of the stocks that have been reporting. There's been some mixed reviews in some of the stocks have been reporting, and a lot of stocks start to show some break or some weakness in their armor, especially if you guys pay close attention to this banking sector, especially regional banks. It's going to be spillover. If these regional banks continue to have these issues, it's going to be eventually going to be spillover to the market, and nobody's trying to quote the word say anything that it's a financial crisis again, but it's threatening to turn into that, folks. Don't be deceived by what you're hearing in the news. It's threatening to turn into that. Do your own research, and you'll see what happened before when we had a big financial crisis. But and when we're in a bear market with this tightening cycle that the Fed is doing, is they continue to raise rates, and they're not talking about even cutting anytime soon. They're talking about holding rates steady where it is. So even if they stop and pause, or whatever they want to call it, and hold rates steady, that's not a positive sentiment on the markets. It's good that they will end up holding. However, normally it takes, for all this tightening that they've done over the past year, it takes a while to start to see the adverse effects to that tightening. Normally it takes about a year or so, and we're just about a year into this tightening cycle, a little bit over that, and we're probably going to start to see the adverse effects of this tightening cycle this summer, more than likely. So get rid of this. I'll show you guys, if you guys paid attention to some of these earnings, especially what transpired over at the close of business yesterday. Starbucks reported yesterday. We got to see how this holds up, but Starbucks reported yesterday. And in the after hours yesterday, Starbucks pulled back just around almost 5%. And right now, it's still down about close to 5%. That was a negative. That was a negative, even though I think it may have had a earnings per share beat, but I think there was probably some negative commentary within the minutes or within the commentary. Also, AMD, another one. AMD reported yesterday, and as of right now, pre-market, it is down almost 6%, almost 6% in pre-market. So, folks, there is we're starting to see some chinks in the armor, folks. And I don't know if you guys have been paying attention, but you guys been paying attention to Tesla? It has been struggling, folks. It's been struggling for quite a bit, and it is still in a strong downtrend. Look at this downtrend that Tesla's been in. It's been in a strong downtrend for quite a bit, and it's not found a way to pull itself out of it. And it doesn't like it's getting any better anytime soon, right? Hovering around this 20-period moving average and threatening to go even lower. So there's some negative sentiment within this market that we need to pay close attention to. I'm heading into a Fed rate decision as of today. So going to be watching very closely today, and we'll see what happens at the end of the day and at the end of this week as to what the overall sentiment of the market is going to show us. All right, folks, I'll catch you guys on the next video.